Hi, everybody. Welcome to Friends Talk Money. I'm Pam Kruger, co-host of Money Track on public television and founder of WealthRamp.com.
I'm Richard Eisenberg, a personal finance writer and editor, and formerly the editor of the Money and Work channels for the PBS site for people over 50, nextavenue.org.
And I'm Terry Savage, nationally syndicated personal finance columnist and the author of The Savage Truth on Money.
We're three friends who like to talk money and all the issues that come with it.
On this podcast, we're trying to help you understand your personal finances
to get you and your retirement on the right path for true financial peace of mind. Hi, every day, the three of us are hearing from people who are either worrying about their future retirement and whether they're saving enough for it, or they're about to retire and they're wondering now if they've saved enough to stop working, or they've already stopped working and now their biggest concern is, are they spending too much of their hard-earned money? It's not easy. Now, I'm going to say that the vast majority of the people I hear from on a daily basis say that they've been pretty comfortable, more or less, having the bulk of their retirement savings invested in the stock market, generally through their plans at work, their retirement plans at work. So even if they've aged, it's interesting. I hear from people who are in their 70s and 80s who are still much more heavily invested in stocks than you might think or think they ought to be. But according to the Wall Street Journal, so much so that the journal reports that 1/5 of the taxable brokerage accounts at Vanguard are held by people 85 years old or older, have nearly all of their money in stocks, which that was pretty shocking. So that to me represents, that seems like it's a little extreme. Those are taxable brokerage accounts. Now, we'll save that discussion for another day, but it shows that we don't all invest and we all don't think the same way about investing for retirement or in retirement. And we all know that the conventional wisdom has always been heavy stocks when you're young, reduce your exposure to the stock market ups and downs as you age. So the 70-30% mix of stocks to bonds becomes 60-40, and then perhaps 50-50 as you age, and so on and so on. And overall, that represents a pretty optimistic point of view on investing in stocks. But what about the other extreme? What about all those people who have been terrified by the markets? They don't say it out loud. They do not see the glass as half full. These people may look at the world differently, and how we see the world matters greatly to our outcomes in retirement. And it's worth discussing because I have some tips for people to feel more comfortable and confident about their future. Richard, Terry, this is surprising too, that a very recent Gallup poll shows that 60% of those not yet retired, they think that they will have a comfortable retirement. They don't think, that they're going to have enough money for retirement, even if they have enough savings. And you can blame inflation, you can blame higher interest rates, always the ever-looming possibility of a recession for at least part of that anxiety, especially for those relying heavily on stock market returns, and those who are going to retire in the next 5 to 10 years. But there's pessimism that's real. It's always been there. We always hear about it, but it's up quite a bit just in the past 10 years. So the behavior is really different. And therefore, the investment strategy for people who see, let's say, the glass half empty, that glass half empty point of view, and managing their anxiety and expectations about investments, it needs to be addressed and it needs to be acknowledged. Richard, Terry, what do you see?
Well, I'll start and say that I can understand why a lot of people are seeing the glass as half empty and are nervous and pessimistic. And part of it, I think, has to do with what's happened to pensions and 401ks over the years. It used to be for our parents and grandparents' generation, many of them, if they worked at a company for years, they knew they were going to get a pension when they retired, and that was some stable income coming in month after month after month as long as they lived. And it was going to be kind of a replacement paycheck for them. And the combination of that and Social Security, I think, helped make them feel pretty confident that they'd be able to pay the bills. But now, with every passing year, the chance that people are going to get pensions from private companies gets smaller and smaller. A lot of companies have frozen pensions. A lot of companies aren't offering pensions at all. So, now there are a lot of us who are retiring, who are going to be, who worry about, where's the money going to come from to pay the bills? And even if we put money into a 401k or savings, or we have Social Security, without that kind of the pension kind of a bulwark, I think people are nervous that there may be months where, because of healthcare expenses or long-term care or the roof or the car or whatever it may be, that they're just not going to have the cash that they need, and the money's not going to be coming in for them. So that's the way I see it. Terry?
All right. Well, I want to make, I was thinking about this now. Let me make two key points. First of all, let's talk to who you are. You're our audience. There are some people, a lot of Americans, who aren't joining in this discussion. They're working day to day. The idea of retirement or what they're going to do beyond Social Security, there are no planning choices for them. Then there's some very, very wealthy people. And Pam, I think your number about people who had after-tax brokerage accounts is skewed, because the vast majority of Americans have the significant portion of their retirement assets that's grown over the years in their 401k. So that's a tax-sheltered account. If you have enough money to have taxes after tax in a brokerage account, you're probably in that upper echelon who's not so worried about will you have enough to make it through your lifetime. You're growing and planning to grow your money generationally and figure you'll leave a bunch of it to your kids. So let's focus on our sweet spot, who I think you are out there. And you have two discussions here that we're having today. The first one is a factual discussion. I'm going to give you an absolute fact, and you're going to base decisions. If you get good advice from an advisor that's not trying to sell you something, we'll come to that. Here's a fact. There's never been a 20-year period where you lost money in a diversified portfolio of large company stocks with dividends reinvested. No 20-year period going back to 1926, even adjusted for inflation. So take 26 to 46, 52 to 72, 90 to 2010, no 20-year losing period. So at the point where you still have a 20-year horizon, or at least a portion of your money you would like to think might have a 20-year horizon, that's the argument for being invested in a diversified way in the stock market. Now, the other argument is we've all lived a long time. Our kids may not have seen bear markets, but I was there. In 1971, the Dow was over 1,000, and a year and a half later, it went to a low of 570. I was on the trading floor of the options exchange when that happened in 73. So it stayed down below 1,000 until 1982. It was still at about 800. So we have not only seen scary bear markets like happened in 2007, 2008, or like the crash from the pandemic, which is only a few years ago, and the Dow was about 17,500 at the lows. And here we're today, 34,000-ish. We have seen precipitous declines. Not many people have seen a bear market that lasted a long, long time. The average is a little over 3 years. But we know enough to be scared, especially at the moment when there's no more income coming in. You're not saying, oh, well, I'm disciplined and my 401k contribution this month is buying stocks at lower prices. Right. I'll worry about it when I retire. Now you're on the cusp. So you have to deal with these two facts. Over the long run, assuming America survives, we're going to make that assumption, because if not, we got our grandchildren to worry about. Yeah. Okay, you want to invest in stocks. But over the short run, you know better, and you can't recoup that money if you don't continue to contribute. And this is where creating a balance that you believe in. I always talk about the bulls and the bears, and I had a third category, the chickens, where you have enough chicken money on the side. Today, T-bills pay 5.5%. That lets you sleep with your disciplined approach to having some money exposed to the stock market to historically beat inflation. That's your challenge. That's the discussion we're having today.
Right.
But
And that, Terry, that
It's
is the challenge.
emotions take over your brain. And
That's
we know
exactly right. So, these are rational statements. This is rational thinking. I'm not saying that it's better, it's wrong, it's right. It doesn't matter. Even if you can't change your financial outlook to glass half full, you can't see that bear markets have come and they have gone, and that the market is up more than it's down. Even if you know this, there are concrete steps that I want to offer right now that I think can boost your retirement confidence. So I just want to share 5 tips that might be helpful to people who don't want to say it out loud. They're just worried and they're anxious about the stock market. And I think that the first one calls for an approach to your financial planning that starts with hyper personalized planning and cash flow stress testing. We've talked about stress testing many times in many different ways. General guidelines aren't going to do it here for you. For you to feel more confident, if you're glass half empty, especially if you're older and you have a shorter time horizon, which, by the way, it might still be 30 years. You have more at stake and you feel like you have less time to course correct, but you can really sit down. I don't know if you can do it alone, but if you do enlist the help of an advisor, it needs to be a fee only, 100% advisor who specializes in retirement income planning. And the reason for that is because what's going to help you the most is for you there's comfort that will come in you seeing the details, because the generalists aren't working for you. The second is, within that analysis, you're going to consider which is really what stress testing is. You're going to consider every possible worst case scenario, nightmare that's threatening you in your mind, that's making you feel discouraged. And your question to that advisor, or if you're doing it yourself, is you want to say, show me how I will never go to zero during my lifetime. It may mean that you have to continue, or your spouse continues to earn income, but you want to know, how will I never go to zero during my lifetime? Once you see that and you see the detail of it, then it becomes a little bit easier to start to adjust and shift your thinking. And that goes hand in hand with the next tip, which is, you're going to basically put your fears to rest by facing your fears. I think that the glass half empty, discouraged feeling ends up being pushed down, and you just don't want to talk about it. You don't want to admit it because everybody else seems to be, rejoicing in their investments in the stock market. And I think that just by facing your fears and looking at the anticipated cost of retirement and what you're most afraid of, again, what you're doing is you're just coming to a brand new conclusion about unwinding the fear. So, for example, the fear of rising healthcare costs could, easily be an unknown, completely unpredictable threat to any future retirees' financial securities. So you might want to consider things like, if you're still working and you're mid-career and you're still, because believe it or not, younger people have the same attitude. Think about maybe funding a health savings account, similar to a tax-advantaged IRA account, specifically for medical expenses. So what you're doing is you're creating plan Bs. You've got plan Bs that you're really concretely putting into place. And the absolute best course of action for those who believe that the worst is yet to come is to develop, a solid cash flow plan and in keeping with the sound investment strategy you can live with, even if that means that you are more conservative and you have more money in cash to keep you comfortable, and then stay the course and only make minor adjustments along the way. One of the dangers with this kind of thinking is that people feel that they need to take really hard turns to this way or in that direction, or sell everything and buy everything and sell everything. It's got to be this mentality where you get into feeling like you've got a solid plan and the plan just needs to be tweaked. And then, the last thing is, just avoiding unnecessary short-term mistakes that, during my conversations with financial advisors, they tell me that a consistent piece of advice has emerged that as you approach the retirement finish line, the last thing you want to do is make mistakes that could be avoidable that are emotionally driven by paying so close attention to CNBC and what's going on in the markets every day. So I think that those are tips that start to really get to the heart of how do you change and become a little more, I don't want to say relaxed, because then it sounds like you're being lax, but I mean a little bit more confident and comfortable that you have a plan and that your plan is solid.
And I think that was beautiful. You have it in a nutshell. You have your steps, and I don't think that people can do this on their own. You made a career out of wealthramp.com, connecting people who are smart enough to recognize these issues, but who need somebody else to hold their hand, to rely upon, but somebody who's not trying to sell them something. So that's why you'll see it all over the website when people write in with questions at terrysavage.com. There's right at the top right-hand corner of my website, find your trusted financial advisor. That's to wealthramp.com.
Terry, don't you think that people don't think of themselves as living 30 years in retirement when if they're, 60 years old, they may have 20.
Well, one of the great things you could do just to get some perspective is go to livingto100.com and take the quiz. Might ask how old your parents live to be and your siblings, and whether you eat green vegetables twice a day and drink enough water and exercise and all that stuff. But the fact is, you could be shocked at what your potential longevity is, especially since our audience have been weeded out. You didn't die in your 20s of stupid drug things, and you didn't die as children of diseases. I mean, by the time you get to this around retirement age, your odds of beating the average longevity statistics are very high. You don't think you're an average person. You're above average, you're going to live longer. But I think this whole concept of making a plan, figuring it out, and then having someone you trust to hold hands is really critical to peace of mind. And what good is it to live longer if every year is another year of worrying? Oh, I want to add just one thing here that you didn't add. I think and then Richard, I could see you bouncing to talk, but I wanted to say one quick thing. One of the greatest worries, I think, as you get older that is alleviated if you do the right planning is I'm okay. I've got everything set. Yeah, I have enough chicken money. If the market goes down, I'll be okay. I'm working. But I think you need long-term care insurance, because the one thing that could come out of left field and wipe out your family savings, leaving your spouse to survive you almost penniless, is the need for long-term custodial care. Medicare doesn't pay for that, only 100 days in skilled nursing after you've been admitted to a hospital. But someone to come in and help you shower and you don't want to put that burden on your spouse. We've done podcasts, so go look in our history about not the ones where the premiums go up every year, but the long-term care insurance policies that are linked to life insurance. So if you don't use it and you die, you have a beneficiary that gets a nice life insurance policy. But if you do need the care, there's plenty of money there. The premiums can't go up. That takes, I think, one of the greatest worries off anyone.
Yeah, because that's what it does for me. Yeah, getting rid of that discouraged attitude. Yeah.
Yeah.
So two things I guess I want to add. One is to Pam, to your point about whether people are thinking about the longer lives. I think they really are, and I think that's what's scaring a lot of people is they're thinking, oh my gosh, I might be around for 20 or 30 years. How will I ever be able to make my money last that long? Especially if I'm retiring at 65 or 67 or 70. Where's that money going to come from for all those years? In our parents' or grandparents' generation, if they lived 10 years, that was common and lucky. These days, 20 or 30 years is not uncommon. And so I think people are nervous about that. And, we want to be doing what we can to try to help relieve some of that anxiety, because we want them to understand they may have long and we hope healthy lives, but that's something you need to try to plan for. And then that gets to Terry's point, which is, I agree with what you said about long-term care insurance. I think it's really true for all types of insurance. I think, if you're nervous about whether you're going to run out of money, that's the time you want to reassess your insurance, all kinds of insurance, because insurance is to protect you against these big financial risks, against catastrophes. So do you have the right health insurance, the right Medicare plan if you're over 65? the right homeowners insurance, auto insurance, long-term care insurance, all that sort of thing. It's not a guarantee that you won't have trouble later on, but it can really help prevent some terrible catastrophes that are going to cost a lot of money that could be covered by insurance because you've been paying the premiums. I think a lot of people just don't want to think about insurance, and sometimes that's a mistake.
Yeah. I mean, that's what this podcast is all about. And that's why today I wanted to focus and take a second to stop and recognize and acknowledge that not everybody has an optimistic outlook. And it's not something that they walk around talking about. And they're not downer people. It's just they don't see it the same as other people. And the average person will spend 30 years in retirement. So it's really important to remember as you start to get through this process of feeling more comfortable that one can't simply stop investing during the 30 years of retirement. So we know there are plenty of reasons to feel a little bit worried about the unknowns of the future. Even if your glass half empty, you have some trepidation and some concerns. And who here can say that they feel A-okay when there's a dramatic stock market correction that puts a dent in your savings, that you see it on paper in your statement? I talked with Mark Lieberman. He's the founder of Shore Pine Wealth Management in Tiburon. He's one of the advisors, the fee only advisors in my investment advisor network. And he works with clients who see the glass half empty. And lots of times it's interesting, they're retired doctors. And I don't know why, but it's, sometimes I don't know what it is about that profession, but these are very intelligent, very educated people. And then of course there are people who are mass affluent who, like you said, Richard, they were counting when they started out their careers and having a pension. And they're not made for investing. They're just not mentally inclined that way. But Mark tells his clients, and I love this saying, remember that the stock market takes the escalator up and takes the elevator down. And what he's pointing out is that humans don't like acceleration, which is why the down markets feel so much worse than the up markets feel good. And that's important. That's been proven in studies over and over again. We're much more affected by the pain than we are by the feeling of elation when the market goes up. And that's why it sticks in our minds so much. So it's important to consider that what Terry was saying when you're in that frame of mind. Stock markets go up about 2/3 of the time and down 1/3 of the time. But it does do the escalator, elevator.
It hurts more in a bear market. I've been through enough of them. I'm here to tell you. So the point is, know yourself. If this is really important, understand the facts with someone you trust, and then know yourself. I'm here to tell you, I'm really here to tell you that while I believe in the stock market over the long run, I've seen the benefits of it, of the growth of it. You get to a certain stage and you say, I need more chicken money. How much money? There's an old saying in the stock market, sell down to the sleeping point. That doesn't mean sell everything. It means make an informed decision of how much cash. And today, I just want to say this, today, it was very hard for me to stick to that philosophy over the last 5 years because they kept a savings rate so artificially low. But as I remember the words of the great chicken money investor, I'm not Bernard Baruch, I'm not so concerned about the return on my money as I am about the return of my money. So chicken money goes into T-bills and money markets and CDs, and don't let them rip you off and pay you only 3.5% on a CD because you can buy treasury bills. Go to terrysavage.com. I sell nothing there. I have no links that get paid. There's a box on the right called How to Buy Treasury Bills. It explains how to do it. Minimum $100. You link right to your bank account, and every Monday there's an auction. And nowadays, chicken money is getting very nicely rewarded. How long will rates stay high? That's $1 trillion debate every day in the bond market. But you are getting paid to have some chicken money.
Finally. And Rich, before I go to your final thoughts, I just want to point out along those same lines, keeping a long-term perspective, or, maybe thinking that your husband or your wife who has these, maybe it's not you, maybe it's your spouse, who has these deep fears that can keep you from being proactive. And that means buying treasury bills. It means doing anything. And so sometimes it can paralyze you because maybe it's not you, it's your spouse. They feel that way. And so the two of you decide to do nothing because doing nothing feels better. But remember, doing nothing is actually doing something. Richard?
Yes.
Yeah, the other thing I would add to that is I feel like sometimes people, even if they have advisors, are a little embarrassed, a little shy, nervous about admitting what they're worried about because they don't want to seem overly scared. They don't want to seem like they are not intelligent.
Right.
And so they just don't say anything and they keep it to themselves. And that's the worst thing. So my advice is if you have a financial advisor or you get one, to be very open about what are you worried about and hear from the advisor about whether you have a real reason to be. Maybe you do, but maybe probably you don't, or not as worried as you are, and they can show you why not or what you can be doing to try to alleviate that. But if you don't bring it up, they'll never know.
Very good, right.
Exactly. I love that's great advice. So, I hope that some of our tips, or even just talking about this out loud, might help you worry a little bit less and help you enjoy the day a little bit more. Just remember, we're always here. We're listening to what concerns you the most. And if you like our podcast, by the way, spread the love. This is friendstalkmoney.org, and we'll see you next time. Bye.
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 Friends Talk Money is funded in part by a grant from the Investor Protection Trust. The IPT is a nonprofit organization devoted to investor education. Since 1993, the IPT has worked with the states to provide the independent, objective investor education needed by all Americans to make informed investment decisions. Visit investorprotection.org. We also receive support from the North American Securities Administrators Association, known as NASA. It's the oldest international investor protection organization. NASA's members include state and provincial securities regulators from the U.S., Canada, and Mexico who serve on the front lines of investor protection. Recognizing that education and awareness are powerful tools in the fight against investment fraud, NASA is pleased to sponsor Friends Talk Money. Here are 3 important tips to help you protect your money from fraud. With investing, there are always risks, so be cautious of anybody telling you that a certain investment is guaranteed. You should also proceed with caution if somebody is promising very large investment returns. This is a common red flag for investment fraud. Last and most importantly, be sure you're working with a licensed or registered financial professional. You can check your advisor and make sure they're licensed by visiting brokercheck.finra.org. NASA is your partner in keeping you safe and helping you avoid investment frauds. Visit nasa.org and click on the Investor Education tab to learn more.